Hey, this is Justin from breakintocre.com, and in today's video, we're going to talk about how rent control affects commercial real estate. So if you've heard of the new laws being passed recently and you want to know how those are going to affect the commercial real estate landscape going forward, make sure to stick around for this video. Now, if you're new here, on this channel, we talk about real estate investing careers and real estate financial analysis. So if you're looking to break into the industry or advance your current real estate investing career, make sure to subscribe and hit the notification bell. Now, the affordability gap continues to widen in the US, with renters being forced to spend a higher and higher percentage of their annual incomes on rent every year. And with about half of Americans spending more than 30% of their annual incomes on rent each year, this is most pronounced in major US cities and coastal areas, which is also where the majority of higher paying jobs exist as well. In fact, according to Zillow rent statistics and US Census income data, renters in New York City spent 38% of their income on rent, San Francisco renters spent 39%, Miami renters spent 40%, and renters in Los Angeles, Long Beach, and Anaheim spent a whopping 47% of their income on rent in 2018. And with these numbers continuing to rise, several states took action in 2019 to create additional rent control guidelines, with California and Oregon enacting statewide rent control, New York increasing tenant protections in rent-controlled properties, and several other states, including Washington State, considering a similar path. So if this trend continues and additional states adopt some sort of rent control, how does the commercial real estate landscape shift, and what do commercial real estate investors need to be aware of? Well, first, these rent control provisions create uncertainty in the market. So if investors can't be sure of the laws and regulations that are going to go into place in a certain state or city, that's going to mean that investor can't be sure of underwriting assumptions to make on the deal, and because of that, many investors will look elsewhere to find properties to invest in. In turn, this can often mean decreased investor demand in those markets, which leads to higher cap rates and lower valuations on residential deals. Additionally, for those markets that do already have predetermined rent caps in place, this can also decrease valuations simply because investors can't underwrite the big 10 to 20% rent increases that they may have traditionally been able to underwrite with a value-add business plan in the past. And without those rent increases, that decreases future projections for net operating income, total cash flow, and ultimately the exit value on the deal. This effect has already played out in 2019, according to a study done by Real Capital Analytics, a prominent commercial real estate research database that tracks multifamily sale data. The study took a look at 12 different markets regulated by rent control and found that 10 of those markets saw cap rates increase in 2019 versus only 19 of the 46 remaining markets without rent control seeing cap rates jump during that year. Now, this might not only affect sale valuations, but it also may come up when loans mature and properties need to be refinanced. If valuations have dropped due to rent control regulations, that's going to mean decreased valuations for loan sizing purposes, which could lead to decreased loan proceeds in a refinance scenario, which could potentially cause an increase in defaults as the loans on these properties mature. Rent control can also make it much more difficult for developers to find deals that pencil, which ultimately leads to an even greater shortage of housing supply, which is how rents got so high in the first place. This was evidenced by a 1994 Stanford study that took a look at the impact of rent control on tenants and landlords in San Francisco. And the study found that while rent control incentivized renters to stay in the San Francisco area to keep their rent-controlled unit, it also disincentivized real estate developers from creating new supply, which drove rents up in the long term and made housing more unaffordable at the end of the process. So at the end of the day, while rent control can be helpful for current residents of rent-controlled units, these regulations have generally proven to decrease the supply and overall quality of residential housing, which ends up leading to higher residential rents in the long term, which is what was trying to be avoided in the first place. Overall, real estate pricing is driven by the basic economic premise of supply and demand, and the past has proven that the most effective way to ease residential rents is to create additional safe, clean housing in the areas that need it most. So if you think you might have rent control coming into your market, I hope that was helpful in understanding the potential implications and how that might affect the commercial real estate landscape going forward in 2020 and beyond. Now, if you are modeling deals with a rent control component and want to know how to model different rents over time, make sure to check out the Real Estate Pro Forma Modeling Masterclass. That's going to walk you step by step through how to build a multifamily acquisition and renovation model from scratch in Excel and how to incorporate things like rent changes over time as tenants vacate. And if you want access to all Breaking a CRE courses, all Breaking a CRE models, and some additional one-on-one support, check out Breaking a CRE Academy, and I'll link that in the description as well. So thanks so much for watching. If you like this video and want to see more content like this, make sure to let me know by hitting the like button, subscribe to the channel, and share this with anyone else who might find this helpful. Thanks so much for watching, and I'll see you in the next video.